Hello everybody, my name is Torin Dove and thank you for checking out today's video. Today I'm going to be going over common investing mistakes that you're likely to make as you first kind of venture into making your own investments. I myself have been investing for 5 years. I loved it so much I actually went to college specifically for finance and all things to do with investments, and I just want to kind of give some tips and kind of explain some things on how you can kind of get started a bit and where there are common pitfalls that you may end up stumbling into as you try and begin this next process in your investing journey. So without further ado, let's get into 10 common mistakes that you might make while trying to invest that hopefully with this video you can learn to avoid and learn to look out for on your own. So my first common mistake is not doing your own research and not using your own judgment. Now, as you kind of brave into starting an investment portfolio of your own, you're likely to go onto Yahoo Finance or potentially look on different YouTube videos or look online just for different types of investments you might make. You might look up something like best stocks to invest in or anything in that nature. And you're going to be faced with lots of different opinions and some companies that are really just after trying to make a few bucks. I know I mentioned Yahoo Finance, so we'll go down that road for a little bit, but as you brave onto Yahoo Finance, you're going to find a lot of what I would consider very much clickbait titles, and a lot of these companies, I won't go into the specifics of which companies, just know use Yahoo Finance as like a baseline for beginning research because they can have good info, but a lot of the times these companies, they hire students roughly my age to write all of their titles, and basically what they're doing with these is they get paid based on how many clicks they get onto each different article, because at the end of the day these different articles are trying to cycle you over to you paying them money for their subscription-based services. And when I first started out investing, I actually ended up falling into this path and kind of learning a bit about that by accident. I was a 16-year-old. I really didn't have that many family members who invested, and I really wanted to try and make a great portfolio for myself. And so naturally, I figured, well, these are people in the space who study it constantly and everything like that. Surely they know what they're doing. And so what I ended up finding over time is a lot of these articles, what happens is they'll post out about 2 or 3 different articles covering a stock. Let's use Nvidia, for example. Now, the first one will be something like, you need to invest $10,000 in Nvidia right now. It's going to set you up for generational wealth. Or something really clickbaity like that, set to explode, anything like that. Then they'll also end up posting, Nvidia's the worst company you can put your money in right now, why you need to avoid this and invest in a different AI company. And they're trying to get 2 different types of customers here. But typically there will be a third one later in the day where, depending on which article was getting more clicks, they'll kind of second and double down on that, and they may even actually remove the critical or the positive article depending on which one was getting more clicks and better comments that would kind of circle through these customers. So, as I mentioned, I fell into this trap when I first started investing. I think I paid $60 for a year-long subscription for one of these services that was basically a glorified stock picker. And so it gave me 10 different companies that the people at this company thought were really set to explode. And this is a very well-known company, like it's going to be one of the prominent ones on Yahoo Finance. But what I really found was a lot of their investment picks were just straight up momentum picks. It was just whatever was hot in the market right now. And I realized that pretty early on as I started taking more investment classes and really trying to deep dive into it and doing my own research every day was, hey, it's just pitched multiple Mag 7 companies at different points depending on when one's really exploding. And a lot of times what would happen is they'd put like companies like, let's say they put Shopify at number 1 because this was right during a humongous drop shipping thing, and then Shopify had a bad quarter. It instantly get dropped out of their top 10. They quit recommending it to you, but they still made that recommendation, and if you were just fully trusting them for all of your recommendations, you would have still invested in a company right before a terrible quarter, and then suddenly, it's dropped, no record of them making that recommendation for you. So with this tip, really what I would set out doing is have a process. Try and set up a process. I'll quickly walk through typically what I do I'm more of an active investor, but you don't necessarily have to do this. Single stocks definitely aren't for everyone, and they really shouldn't be for everyone. I mean, a lot of people can benefit greatly just by floating down the river. You don't have to try and find the specific point and spend a bunch of time into it, but I'll get more into that in a later tip. Typically for me, what my process kind of looks like is I start with a screener. Now, if you're not aware of what that is, I typically like FinViz. I've pointed a lot of people in the direction of FinViz, and for completely free, you can go onto their screener, you can set whatever PE ratio you want, you can set up like different dividend percents, you can screen analyst recommendations, and you can just kind of pick and choose what you want. If you want something in a specific industry, or maybe you're looking to diversify internationally with options there, you can also set up there. So once I do that, typically what I like to do is I like to go onto their investor relations website. I might look at one of their presentations. Now, keep in mind with the presentations, these are very much hand selecting the best data and the best things that they think represent their company. But so they're not going to have like any of the red flags right away there, but this will give you like a decent indication of, okay, this is what the company does. This is what they're trying to prioritize going forward. They'll often have key highlights for their revenues. If you aren't seeing a lot of like revenue oriented stuff or any financial data, that might be a sign right there. Okay, this is something I need to look further into before I make any sort of investment in it. So after I kind of look through their PowerPoints and trying to see how they would pitch themselves to not only me, but other potential investors, I then like to go and look through their annual statements. Specifically, I try and do like 2 to 3 years of 10Ks, just kind of see any patterns, dig through financial data there, look at their balance sheet, their income statements, and also it's a really great time if you're going to start looking through a 10K to just go over the business model really quickly, because you may think you understand a company, like let's say Google. Like if I say Google, a lot of you probably think you'd like Google search and you kind of cut it off there, but they have so many different businesses and even things they've acquired that you really will benefit just reading through the 10K specifically in the business overview section and kind of getting an idea about that. But then I also like to go to their MD&A, which is like their management discussion and analysis kind of. And this will kind of give a lot of like forward looking, what they're trying to do. A lot of times there will be commentary on that year, if they experienced any problems or anything like that. And around this time, I genuinely have a decent idea whether or not this is a company I would like to invest in. Because what I specifically look for is I'm more of a value-oriented investor, and so I also like to look for like cheaper valuation companies that still have relatively good growth prospects that I can pay a good price for. So again, if all of that sounds too complicated and you're not wanting to put like any time whatsoever, there are going to be people like that, and honestly, that's really awesome. You can pretty much just go onto Morningstar, look up best ETFs. I highly recommend VOO and something that tracks the S&P 500, and maybe just pick out 3 or 4 ETFs that are diversified enough. So like the S&P 500 and maybe some international markets and maybe some like dividend appreciation ETFs, and really just every single paycheck dollar cost average into those. And that's really all you need to do if you're just looking for as simple as possible. And to be honest, so I have beaten the market pretty consistently throughout my investing journey so far, but there really isn't a lot of statistics and data that shows that active management successfully performs against the market. In fact, it's a bit of the contrary, and a lot of the active investing success boils down to almost borderline luck. I truly believe if you do significant quantities of research and then you align that with patience, you'll outperform the markets, but there really is no guarantee on that whatsoever at all. But that being said, if you really you want to float down the river, just maintain in the markets, be in the markets, not necessarily dig through a bunch of data, and you don't have time for that, you can still make a very, 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 very good decision for your financial future simply by doing that. And that kind of gets us into our second thing. So the second mistake that you can avoid is not really having a game plan and a thesis, and kind of selling things way too short. So I like to prioritize creating durable theses and also sticking around for long-term compounding. So I've made several videos on stock analysis for my Microcap Mania channel and like the portfolio there. And kind of what I'm looking for there is anything in the 3 to 5 year time span. So I'm looking very much ahead towards the future because we want to create compounding stocks. Now, what do I mean by compounding stocks? So compound interest is kind of the 10 plus 10 equals 21 rule. If you average a 10% return, you're going to double your money in 7.2 years. And I know that might jump out and be like, why wouldn't it be 10? But compounding interest, as Warren Buffett and Charlie Munger have described, and many of the investing greats, really is one of the wonders of the world. Compound interest, when you take that 10%, so the first year you're going to be receiving that 10%, but the second year when you take that 10%, you're including all of the money you made with that original 10% as well. And you can kind of see how this can potentially snowball and really fastly grow your money. And towards the end of your investment life cycle, this is when you start seeing these massive jumps in wealth. So I really like to have long-term options, whether that's in single stocks or ETFs. So in my Roth IRA, I primarily have it all in VOO. Admittedly, it could do with a little bit of diversification internationally, but primarily I have it all set up from a time when I just threw in $3,500 when I was working my first job. I don't intend on touching it whatsoever. Instead, I intend on adding more into that set position and just allowing it to compound, because even in those 5 years, it's grown to almost double what I originally put in, and that's solely due to compound interest and then reinvesting those dividends, which I'll get into in a little bit. So the next thing is tip number 3, don't sell without a solid reason. So as you can kind of see, a lot of these tips really boil down to being highly educated in the positions you're making with your financial decisions. And so I'll give kind of a personal example. Back during that time when I was very, very, very reliant on this investment subscription service through a media source for investing, I stumbled upon NVIDIA, and this was probably about 4.5 years ago. And I made an actual, pretty reasonable investment into NVIDIA during that time. And I didn't really do a ton of research inside of, what that looked like. It basically just popped up on my top 10 recommendations, and I figured, okay, this is something I should look for. And I made about a 40% return. If any of you have any idea what NVIDIA has done recently, you're going to understand the pain I'm about to go through while explaining this story. But NVIDIA got dropped from their top 10 recommendations in terms of what I should be invested in. And I didn't really know the ins and outs of the NVIDIA business model and how high demand it was for these chips in terms of generative AI. I didn't know the first thing except graphics cards, really. That was the extent of what I knew about NVIDIA's business model, because at that time I was fully reliant on other people's opinion and other people's investment research, and so I sold at a 40% gain. Obviously, NVIDIA's gone on to do incredibly well since that time. I've consistently looked down in shame at that moment, having given up a sizable amount of money for a college student because I didn't do my own research. But that decision right there kind of made me into the investor I am today, because you will not catch me dead not understanding a company that I am investing in and not having an idea of, okay, this is what it would take for me to sell this position. So now that we've gone over that story, the investing tip number 4 is don't only diversify in U.S. stocks. Now, I think a really good example for this would be kind of what's going on right now with the tariff situation. As always, I'll try not to get super political. I'm sorry if any bias comes through in that. I typically like my administration to do what's best for the US economy, and sometimes I don't think they're doing the best for the economy. But regardless of that, what we learned through this tariff situation, and I think a lot of people really learned this, is it's not enough to just throw your money into the S&P 500 and only be invested in United States stocks. I know a lot of countries, even international investors, do that, but let's say the United States no longer becomes the trade dominant powerhouse it's been and the economy kind of goes and sinks itself. There's going to be plenty of opportunities for emerging markets. For instance, India's been doing really, really well lately, and they have very large population growth. There are plenty of countries. The EU, for instance, is a really decent power play to look at right now. And so really trying to find some ETFs that target multiple areas, or even just a large international one, need to be added into your portfolio. It's not enough to only diversify across one country or one region. And a lot of people, they just only think about where they live in terms of what they can invest in, and they'll just only invest in those companies. And simply put, that you can't do that. This administration has proven that on a dime, they can completely sink our economy. There's absolutely no point in only investing in one country's companies. Next, I'd say if you don't feel confident in reinvesting the dividends, why do you own the company? And this can also be partnered with don't invest in companies solely for the dividends. Now, I have a really great example for this. So when I did the CFA Research Challenge, I looked at a company specifically that was a dividend aristocrat. They were a large beverage company that a lot of you would probably know some of their products, and they prioritized dividends above anything else. They were a family-owned company. That's going to be brought into account. But if you were solely a dividend investor and you hadn't done any amount of research into this company, you just simply look at the dividend and be like, wow, this is great for my account. I can get this much money every quarter out of this investment. But if you looked out at all, you could see that their payout ratio was well above 100%. They were debt financing special dividends, and also these dividends weren't even paying up for your shares depreciating in value. They were going straight down. They weren't trying to put any money into growing the company. They were quite simply content to let the company run its course, suck whatever money out of the company they could in the form of dividends, and it really didn't benefit anyone except the family members at the top. And so you're going to see it a lot with specifically older investors. They'll hold on to companies that are so far along in the company life cycle, it's a joke, like dying, like the Sears, like they'd be invested in Kmart before Kmart died, like companies like that, and it's just they're losing market share consistently. Their stock price is literally nosediving into the ground, and they're just content to hold on to these companies because, oh, it pays a 9% dividend. That 9% isn't even covering your losses. And a lot of times these people won't even invest the dividend or reinvest the dividend. And why would you? This is a company that's terrible, that is losing you money, even incorporating those extraordinary large dividend percentages. You should not invest in companies only because it has a 10% dividend or a 9% dividend. Instead, what I would highly suggest doing if you are trying to simply create a dividend portfolio, look at an ETF that has a 5-star rating in terms of like the dividends. Vanguard has a really, really good dividend ETF that primarily focuses towards American companies. Go through that list, kind of understand what their payout ratio is, see if they have any growth percentage whatsoever, because a company needs to trade exactly flat for you to maintain that 9% dividend. And what I mean by that is if it just shoots straight down, it's eating into any of the money you're making with the dividend. So if you can get a company that ideally goes upwards and pays a solid dividend, then you're going to be in a good boat. if you don't necessarily have the skills or capabilities or time management or anything, and I don't blame you to dig through all of the stuff again to try and find those companies, just invest in a solid dividend ETF. There are plenty of them. You can do international, domestic, anything like that, anything you desire, and just take the dividends from that. And these will actively be invested in a wide variety of companies. If one of them's tanking off the face of the earth, many of them will probably be appreciating in value and offset that sum. And you'll be in a much better position than simply holding on to these dying dead companies that require paying a 9% dividend for anyone to own their shares. Now, the next mistake is don't invest outside of your realm of competence. And again, I've been preaching this entire video. I feel like any investing video I give really just turns into the ETF. Only invest in ETFs. I'm not trying to do that. I like single stock selection. I do have accounts that have ETFs, but for a realm of competence, you need to understand what you're investing in. Again, I have a personal example with this story. So years ago, like one of my very first investments was because a family member of mine told me about a company. We're going to get into don't trusting your family members if they don't know like more than you. But this family member at the time, I was very, very early in investing, and they had invested for a long time. Surely they knew exactly what they were doing and could tell me kind of where I should park my money. And so I fully trusted them. And it was this very, very, very new company. They had 0 sales, 0 revenue, and they were going to prioritize hydrogen energy. And they had like a 20 million market cap, like just the most penny of penny stocks, just a pitiful company. If I at the time had done any common sense, any reasoning, anything of that nature, or had seen that opportunity now with like my knowledge base now, I would have immediately said, nope, this is crap. I'm not going to invest in it. I'm going to lose money. No, thank you. They have 0 revenues. They don't necessarily have a plan that happens in a short time. No, thanks. Instead, what I did was I parted with a very large amount of money, naturally, because I was fueled by greed. And I thought, okay, if this company becomes the next efficient energy company that prioritizes hydrogen energy in the timeline they say that they're going to bring about this much revenue, then I am going to be a multi-millionaire in 5 years. Realistically, you're not going to be a multi-millionaire in 5 years. Somebody should have just looked at me and been like, why are you trying to make investment decisions? But, we put in a bunch of money. Over the next 2 years, I had plenty of great opportunities to look at my giant loss in that company and be like, you know what? Enough's enough. Let's try and save whatever money we have and just pull it out and just accept that I made a terrible mistake. Instead, what I ended up doing was I was just so disappointed with myself. I didn't touch that investment at all. I just decided, okay, we'll just hold this until it either goes bankrupt or explodes. So when I invested originally, I think I put $400 and something into this company. At the lowest point that it went, it was $20. That $400 had turned into $20. And I'm not even particularly upset because I've significantly made a lot more than that overall with my other investments, which is why you need to diversify so that if you do something that incredibly stupid, you're not screwed in your account. But I was more just upset at myself that I had so many opportunities to pull out my money and that I had invested in a company I knew nothing about hardly. I didn't know anything about mining or energy or had any idea how long this would take if they were trying to do this legitimately, had no knowledge on that base. Instead, I had simply been given a recommendation, I went for it, and I lost a lot of money. So hopefully, if anybody is still sticking around at this point in the video, if you have a situation like that, if you have friends or family, hey, you need to look at this, it's going to explode and we're going to become millionaires or whatever, just hone it in, look through things. If it doesn't make sense, if it's not a good investment, Say no. Don't just blindly trust people because they're your family members. Okay, moving on to the next tip. Don't make investing unnecessarily hard. Make it something you can easily commit to. So for a lot of people, like the vast majority of people, as I've mentioned numerous times and will continue to mention, simply dollar cost averaging into ETFs that you don't even necessarily need to know everything about what the US economy is going to do or what the European economy is going to do or anything of that nature. Just make it a very, very simple process. Okay, now, if you are like me and you like active investing and you like managing that, still try and make it an easy process that allows you to go through multiple different companies. Once you get to the point where you are like very, very, very picky in what you invest in, you're going to be much better off. So be able to say no, give yourself a process where if something doesn't fit all of the criteria, boot it out, because you want to be able to have confidence to hold on to these companies for a long, long time. You're not simply just buying stock. You are buying an ownership share in a business model. If you are not confident in that business model, absolutely do not become an owner of that business model. Next, accurately define your time horizons and make sure your investments match those time horizons. There have been a lot of times in my investing journey where I have convinced myself and I have told myself, I want to be a long-term investor. By being a long-term investor, I'm able to compound. I'm able to grow my account. And yet time after time again, I've caught myself and then I've looked back at it and been like, why did I bought into hype, I bought into momentum for a bit, and I invested in things I had no intention of holding long term. And when I go over the best performers in my portfolio throughout like my entire time investing, they've been companies that I've felt very, very confident in, I've put money into, I have basically turned on in reinvesting my dividends, and I've just kind of forgotten about them. Because I really believed in their business model, I knew they were going to continue growing their business, and I knew their management team was competent. When you get caught up in short-term investing, you don't look at any of that. You don't even hardly care about anything outside of what price you're buying. And if you only know the price of businesses and the price of stocks for those businesses, you really don't know a thing relatively. You have no idea. You don't care what's going to be happening in the next upcoming quarters. You don't care about what's going to be happening in the next year. You don't even care about the direction of the business. You're just simply buying in to simply sell that share at hopefully a higher price. But by doing this, you get caught into really short-term investing. You get caught into day trading. And day trading, statistically, you're much better even just playing the casino odds than trying to become a successful day trader. It's not going to happen. So, my next advice, don't get caught up in the day-to-day. Sometimes nothing of note happens for a while. So this really goes back into controlling your fear and greed. You're going to be doing lots of research. You're going to probably be on Yahoo Finance. You're going to be opening up your Schwab or Fidelity or whichever company, Robinhood, anything you invest on. It is very, very, very important to just know that the market is just going to exist. Some days it'll be up 2%, some days it'll be down 2%. That doesn't necessarily mean that something of major note is going on. And you shouldn't try and make decisions based on absolutely nothing. Then, when things are happening and you have the Japanese yen trade explode, or you have tariffs, or you have COVID, those are when you actually need to pay attention and put time in to understand what's going on. And you can probably find arbitrage opportunities and mispriced opportunities, or you can buy significantly more into your ETFs if you're going that route. But understand there are going to just be days where absolutely nothing happens, and simply living on Yahoo Finance or living on your investment accounts does the exact opposite of good for you. And then lastly, my final tip, take meaningful positions. I've seen too many family members and too many people who have come up to me and asked for investing advice or anything in that realm, and I just look through their portfolio, and you just have to screen through all of their positions, and something will take up like 0.02%. if that company explodes at 0.02%, it has done nothing for you. It does nothing to have $5 in a company unless you have a portfolio that's like $100. There is no benefit whatsoever in having a bajillion positions with very little money in it that makes up a large portfolio. If you aim for things in the 2 to 5% range, that means you have to be very, very, very confident. You have to have done your research, and these have to be investable business models that you feel good about investing in. Shoot for something like that. Shoot for minimums of the 2 to 5% range. Try and create portfolios with 24 companies. 24 companies is more than enough in terms of diversification. I mean, Charlie Munger literally is like, invest in 5. I wouldn't go that route unless you're like in an ETF account. 5 ETFs is fine, but try and shoot for meaningful positions. And that way, if they do really well, which they probably will at some point, you will end up batting. You don't have to bat perfect by any means, but at some point you'll get a company and you'll really have wished you put in a meaningful sum as opposed to just scrolling. Instead, consider all of those positions. Whichever ones are absolute trash, just get rid of, just collect all of your cash, and then reinvest those into the companies that you want to make a core part of your portfolio. Okay, this was a bit of a longer video than I intended initially, but thank you very much for checking out today's video. If you did make it this far, please like and subscribe to the channel. It really helps me growing and kind of learning this whole process that is YouTube. Thank you very much for checking out today's video. I appreciate you.